Chapter 2, Part 2. Now we're going to look at journal entries and posting. Now, overview. We've looked at what a financial transaction is. We've looked at an account which collects information about a specific type of transaction, like cash would be all in one account. Types of accounts, we have those that are associated with assets, those for liabilities, those with equity. We discussed what is a debit and a credit, and that the basic definition is left side, right side, and it does not mean increase, decrease. It just means right side, left side, because depending on where it falls on the accounting equation determines whether you use a debit or a credit. Now we're going to do double entry accounting, and we're going to actually record transactions. And the last part we're going to look at is the trial balance. That will be covered in Part 3. Now, debits and credits. You debit to increase assets, dividends, expenses. Remember that. Memorize that. Credit. We credit liabilities, revenue, common stock, and retained earnings. These are all increased with a credit. Do not forget those rules and make sure you understand them before you go any further, because it's important to the remainder of the semester. Normal balance. It is how you increase an account. So if you increase an account with a credit, that's its normal balance. If you increase it with a debit, that's its normal balance. If the balance is not normal, it indicates a negative amount. Now, journal entries. You write the account debited first, the amount in the left column, and you write an indent the account credited next and the amount in the right column. Debits must always equal credits. So now let's take a look at an actual journal entry. This is what it would look like. You'd have the date, you would have the account name, say it was cash. You would debit if you made a sale. So it would have been cash because it went up, and it would be sales revenue for your credit because it went up, and at the bottom you would put a description, made a sale. The initial transaction is recorded in the general journal in chronological order and is also called the book of record because it shows both sides of the transaction. So if you saw the cash account had more money than you thought it should, you'd first go to the general journal, look at the cash account, and then trace it back to the general journal, which would show you both sides of the transaction. Now, once we journalize, the next thing we do is post to the general ledger. So we journalize in the general journal, journalize in the journal, and in the general ledger is where we have each one of the individual accounts and all the financial transactions associated with it. So now let's go ahead and go through the process of journalizing and posting. Now we're going to record these entries, and we're going to go through the process of identifying and how we record them, and we're going to journalize and post. So the first thing we did is issued common stock for $50,000 in exchange for cash. So the first thing we want to do is identify the accounts impacted by the transaction, what category they fall under in the accounting equation. So in this case, the two accounts that would be affected would be common stock and cash. Common stock is part of equity. Cash is an asset. Now we're going to apply our debit-credit rules. So since our common stock went up, it's going to increase, and so did our cash. Now, how do you increase, decrease that category of account? Well, for common stock, we increase with a credit, and for cash, we increase with a debit. When you do a journal, always show the debit first and then indent the credit. They must equal to keep the accounting equation in balance and are entered in the general journal in chronological order. So this is our first transaction. So we would debit cash and credit common stock. Then we would post to the general ledger, which shows the activity for each account. We'd see cash, common stock. Now you notice it balances. There's two sides to the entry. Now let's go on to our next entry. We obtained a loan. We borrowed money, which means we got cash and we now owe the money. So we've got notes payable and cash. We have a liability and asset. Now we'll apply our increase, decrease. Our notes payables went up and our cash went up. To increase a liability, we credit. To increase an asset, we debit. So now we can go ahead and do our journal entry. We do our cash as our debit, always first. Notes payable, our credit is always second. And then we're going to post it to the general ledger. Now if you notice, I like to put numbers, and usually you'll put page numbers in the actual general ledger. And that's because you want to be able to go and see, okay, this was my debit. Now to make sure I posted my credit, because that's a mistake you can make. Now, just so you know, today this is all done by the computer, so you may have to do the journal entry, but the computer will post it to the general ledger, eliminating the problem. Now we purchased office equipment on account for $30,000. So we have equipment and accounts payable. We have an asset and a liability. Our equipment went up and now we owe money, so that went up. So we're going to debit our asset and credit our liability because they both went up. And our journal entry is going to be equipment, accounts payable. And we're going to post it to the general ledger. Now here's another thing to remember is whenever we see on account, as we do in this transaction, it means no cash exchanged hands, which means it's either going to be an accounts payable like it is in this case, or it's going to be an accounts receivable. Now we bought office supplies, for $5,000 cash. Again, we have an asset. Actually, we have two assets. And what we've done in this case is converted one asset to another asset. So our cash went down, but our office supplies went up. And now we have our journal entry. And we're going to post this to our general ledger. Now we received $25,000 in cash for services performed. So we made sales. We've got an asset and stockholders' equity. Cash went up, stockholders' equity went up. So now we can do our journal entry. We're going to debit cash and credit sales. Post to the general ledger. This is what it looks like. Now we provided $10,000 in services on account. Again, whenever you see on account, no cash exchanged hands. So in this case, since we provided services and now someone owes us money, it's going to be an accounts receivable, which is an asset. And it went up along with stockholders' equity. So we know our debit and credit. And now we can do our journal entry. Now we received an advance payment for $30,000 for future services. Now here's the thing to remember. Whenever we get paid cash in advance of doing something, we are creating a liability and it's called deferred revenue. The reasoning is that if we don't provide the services, we have to give the money back. So we have an asset and a liability. They both increased. So now we have our debit and our credit. Now we're going to post to the general ledger. Now we paid $20,000 on account for the equipment. Now what we're doing is we're going to reduce our cash and reduce an accounts payable. We have an asset and a liability. So we're going to decrease cash and decrease our liability. So we're going to credit cash and debit accounts payable. And now we're going to post that to our general ledger. And as you can see, now our accounts payable is only $10,000 because we originally started with 30. We paid 20, and now we have 10 left. Now we paid rent of $4,000. We would have rent expense in cash, which is equity, and cash is an asset. One increase, and our cash decreased. So we debit rent expense and credit cash for our journal entry. And again, we post that to the general ledger. Reduce our cash and increase rent expense. Now we've paid our utilities. Again, we've got an expense, so we're going to reduce our cash and reduce our equity. And that's going to be a debit to expense. Expense is normally always a debit. And our cash would be reduced by $600. And now we're going to post it to the general ledger. Now our last thing we did is paid dividends. Cash and dividends is an asset in stockholders' equity. Cash went down and dividends went up. So there's our credit and debit. Here's our journal entry. And then we post this to our general ledger. Now let's take a look at what our general ledger looks like. So here's what it would look like, and they would actually be separate. If you're doing it manually, they would be separate cards. And in the computer, it would be a separate account. You would have assigned numbers to all of these. So for the cash, we would add up all our debits, add up all our credits. And in this case, we get a debit balance, which is the normal balance, which means our cash is not overdrawn, which is $84,400. Our accounts payable has a credit balance, which means we still owe $10,000. That's correct. If that had a debit balance, it would have meant we overpaid. Now, our sales, we have a balance of $35,000. So if you notice, all of our accounts have normal balances. Now we can go on to part 3.